trying to keep up with energy markets these days, it really feels like you're navigating a storm, doesn't it? Prices are just tossing and turning. Government policies seem to change course without warning, and then boom, you get hit by something totally unexpected, maybe even driven by nature itself.
It's a real challenge, yeah. The sheer speed and just the number of factors influencing things globally. I mean, traditional analysis only gives you part of the picture now.
Right.
You really need to see the whole ecosystem, how it all connects.
And that's exactly why we've done this deep dive. We've sifted through, well, a whole stack of recent material, market analysis, industry newsletters, research reports, trying to pull out the essential insights for you.
Yeah, our mission today is really to help you cut through all that noise, to help you understand what's truly shaping these markets right now. We'll look at signals from the trading floor, the big swings driven by policy and nature.
And even the long-term bets being made in the industry itself.
Exactly. It really highlights just how many different forces are pulling at these markets simultaneously.
And, one question that kept popping up as we went through the sources is, how much are these energy markets now being shaped by these unpredictable forces outside of that traditional supply and demand equation?
That's a key question.
We'll see hints of that as we dive into everything, starting with, say, crude oil's technical picture, then natural gas volatility.
Then the major geopolitical stuff, environmental impacts like wildfires.
And finally, yes, some specific industry deals that are happening.
Okay, let's unpack this dynamic world.
All right, let's kick off with crude oil. Looking at the big global benchmarks, WTI and Brent, early June saw some back and forth movement. Prices slipped a bit on June 4th.
Right, after gaining the day before.
Exactly.
Right.
It was just a reminder that even these small daily moves can feel pretty choppy.
Yeah, and this is where, technical analysis comes into play. Traders aren't just looking at the day's price change. They're analyzing patterns, indicators on charts, looking for clues about market sentiment, potential direction.
And the technical picture for WTI crude, well, according to the analysis we saw, it's quite interesting. The price was sort of consolidating trading sideways in a tight range near a key level around $62.80. But it was bumping up against this noticeable resistance point near $63.50.
Right, and what's fascinating there is that even with that resistance overhead, the charts were showing some patterns that often suggest maybe underlying momentum building for an upward move.
Like what kind of patterns?
Things like the price trading above key moving averages. Those lines that smooth out price data to show trends. That suggested the path of least resistance could be higher.
Okay, so if the price manages to break convincingly above that $63.50 resistance level, the technical signals are saying it could open the door for a move towards higher targets, maybe into the mid-$60.
That's the idea. Yeah. Traders would look for a sustained push or maybe a clear closing price above that resistance zone as a potential buy signal.
But of course, there's always the flip side, right? If the price fails to break through that resistance, maybe show signs of turning back.
Then that could signal a pullback. Exactly. In that case, the analysis points to some important support levels to watch, particularly down around $62.
Okay.
That area, it includes several technical indicators clustering together, so it's seen as a pretty critical zone. As long as the price stays above that general, say, $62 to $62.80 area, the underlying technical bias, while cautious near resistance, still leans slightly bullish, according to this analysis.
And for Brent crude, the other benchmark, the technical view was somewhat similar, watching for potential minor slips, but with support levels underneath.
Broadly similar, yes. Keeping an eye on key support levels.
Okay, so beyond the charts, what's fundamentally influencing crude right now? We saw some pressure from things like rising U.S. oil inventories.
Right, and decisions by major producers like Saudi Arabia on their pricing.
At the same time, these broader geopolitical tensions, especially involving Russia and Ukraine, they continue to be a really significant factor affecting market sentiment, particularly for WTI prices.
Definitely. And a recent decision by the OPEC Plus group, that's OPEC and their allies, to maintain their planned output increase for July. That was noted as helping to alleviate some immediate oversupply fears.
So that provided a bit of a floor under prices.
It seems so, yeah. Kept prices somewhat firm.
And then you've also got these external economic factors like the value of the U.S. dollar. When the dollar drops, as it did partly because of, renewed trade tensions and tariff threats from the U.S.,
Right.
that tends to make dollar-priced commodities like crude oil cheaper for buyers using other currencies, which can add a bit of a bullish push.
And even with that OPEC plus output decision, ongoing supply concerns persist, especially with tensions involving key players like the US, Iran, Russia, Ukraine. The possibility of sanctions or disruptions, it's still there. It's something traders have to keep in the back of their minds.
Okay, right. Let's shift gears then to the natural gas market. Like crude, it seems to have seen some interesting volatility lately.
It really has. The market had this brief price spike recently, pushed just above what analysts saw as an interim high, around $3.76.
Okay.
But that didn't last long at all. Prices quickly fell back, dropped to a 3-day low.
So it spiked up and then immediately showed weakness. That sounds volatile.
Precisely. It's basically trading against a significant resistance area, kind of hitting a ceiling near the $3.85 level.
So from a technical standpoint, what does that quick fall suggest?
Well, a daily close below a recent low, specifically the low from June 4th, which was around $3.66, that would be seen as a pretty definite sign of weakness.
Right.
That bearish move we saw on June 5th has potentially set the stage for prices to test some key support levels below.
And where are those key support levels for natural gas that people are watching?
Analysts are watching the area around the 50-day moving average, which is currently sitting near $3.52, and also the 20-day MA near $3.51. There's also some notable support from the previous week around the $3.50 level. That 50-day MA, though, that's considered particularly important for the health of the current trend. If it trades back below that, it would be seen as a bearish signal.
So for a new bullish trend to really emerge, you'd need to see a strong move higher first, not just a quick spike.
Yes, exactly. A decisive rally that breaks above the recent high from this week, and importantly, sustains that move without immediately pulling back deeply.
I see.
A move specifically above the $3.84 swing high is noted as a signal for potential further upside, maybe targeting areas above $4.
Okay. And on the downside, what's the critical level to watch before that bullish outlook really starts to look shaky?
The analysis highlights $3.44 as a critical level. That level marked a higher swing low back in May.
Right.
If the price breaks convincingly below $3.44, it significantly increases the likelihood of more bearish behavior. It's seen as a point where the overall bullish view weakens considerably.
So it's a market that sounds like it's bouncing between resistance and support, described as somewhat messy, with some analysis leaning towards the downside right now.
That sums it up pretty well. Right. And external factors are playing a major role here, too. Things like the upcoming non-farm payroll economic data announcement that's always closely watched and can ripple through markets broadly, including nat gas.
And of course, you always have those global factors like European demand for LNG exports and how quickly storage tanks are refilling after the winter heating season. That's always part of the natural gas price picture.
Okay, so let's broaden our view significantly now, because these energy markets are increasingly reacting to forces well beyond just the trading screens. Geopolitics, even natural events, are having massive impacts.
Yeah, one of the biggest sources of unpredictability right now seems to be U.S. trade policy and tariffs. The constant back and forth, the changes.
Yeah.
It's really striking when you look at it.
It really creates uncertainty. The Bank of Canada, for instance, they noted that these frequent changes in U.S. tariffs and just the general unpredictability make them cautious about their own monetary policy decisions, like easing interest rates.
Their governor specifically mentioned how recent tariff increases, like those on steel and aluminum, just underline this unpredictability, and it could directly lower demand for Canadian exports.
Right. And we saw those specific hikes take effect recently. Tariffs on steel and aluminum imports jumping to 50% from 25% for some countries, announced just days before taking effect.
Though the UK got a different rate because of a trade deal, I think.
That's right, yeah. A lower 25% rate for them.
The sources we looked at really dug into this idea of tariff flip-flops. They listed all these instances of changes to illustrate just how frequently U.S. trade policy has shifted direction.
Yeah, things like changing how tariffs are calculated, granting or removing exemptions for certain goods, altering stances on negotiations.
Or even announcing tariffs and then pausing them almost right away.
Exactly. And this pattern of, shifting policy has led to this nickname on Wall Street, Taco Trump, which stands for Trump always chickens out.
Right, about that.
It refers to instances where proposed tariffs or rates get lowered after markets react negatively. What's fascinating and frankly a bit concerning for analysis is that this nickname has stuck. And some market analysts are actually trying to factor in the expectation of these policy reversals into their models.
Wow. So the unpredictability itself has become something analysts are trying to model. That really highlights how policy risk is changing the game.
It really does. It's no longer just what the policy is, but the likelihood it might change and how quickly.
And policy isn't the only unpredictable external force shaking things up.
Hmm.
Natural events are also showing their power to significantly disrupt energy supply.
Oh, absolutely. We're seeing that clearly with the Canadian wildfires, particularly up in Alberta, which is, Canada's main energy producing province.
These fires have had a major direct impact. They forced major oil producers to suspend nearly 350,000 barrels per day of output.
Yeah, and to put that in perspective, that's roughly 7% of Canada's total oil production. That's a big chunk.
Several large companies were affected, right? Cenovus Energy, Canadian Natural Resources, Meg Energy.
That's right. Each had to shut down significant portions of their operations because of the fire risk.
And the scale of these fires is just immense. Tens of thousands of hectares burning, dozens still active and out of control recently.
And while the physical damage to the facilities themselves seems minimal so far, thankfully, a major concern is just the sheer proximity of these fires to crucial energy infrastructure, things like pipeline corridors, specialized oil sands projects.
So the fires were getting dangerously close.
Yeah, fires were getting within just 10 kilometers of sites producing large volumes of oil early in June. It's a real worry.
And the market impact is real, tangible. That loss of nearly 350,000 barrels per day. You mentioned OPEC Plus earlier. That's roughly equivalent to the amount of oil OPEC Plus recently agreed to add back into the market.
Exactly. So it's significantly tightening the market, particularly for those heavier grades of oil. And that market was already facing reduced supply because of U.S. sanctions on Venezuela and just typical seasonal maintenance work in Alberta.
Experts are calling these among the most disruptive wildfire events since that huge Fort McMurray fire back in 2016. And importantly, the increasing pace and scale of these fires, it might signal something deeper, right? A potential structural shift may be driven by changing climate conditions.
That's the concern, yeah, that events like this could become a more regular, albeit unpredictable, feature impacting supply going forward.
So we've seen the volatility from policy, from nature. But despite all these disruptions in this really dynamic market environment, the industry is still making significant long-term investments, striking deals.
Absolutely. It's not all just reacting to the day-to-day price swings. Companies are definitely planning decades ahead.
One example we saw in the sources was BEL Valves. They're an engineering company from Newcastle in the UK, specializing in critical valve technology for oil and gas.
Right. They secured a £5 million order for a project out in the North Sea, the Murlach oil field development.
And BEL Valves is supplying, 20 specialized slab gate valves for the topside platform.
That's it. The Murlach field itself is quite a distance offshore from Scotland. It's a joint venture, BP and NEO Energy, and it's actually being brought back online, recommissioned.
Yep.
Expected operational life of about 11 years, and they're aiming for first oil extraction sometime in 2025.
And BEL Valves got the job because of their proven track record, right?
Yeah.
For these safety-critical, high-pressure applications.
Exactly. A project director highlighted the industry's trust in their technology, and it makes sense the company's been manufacturing for the oil sector since way back in the mid-1960s.
Okay. So moving across the globe, over in Argentina, their national oil company, YPF, seems to have some very ambitious plans. They want to unlock the potential of the huge natural gas resources they have in the Vaca Muerta formation.
Yeah, they have vast gas reserves there. It's an unconventional play,
Yeah.
but their current pipeline capacity really limits how much they can export.
So the strategy is clear. Turn that gas into LNG, liquefied natural gas, and ship it out.
Exactly. YPF has developed what they call an Argentina LNG master plan. It's a multi-phase strategy. The immediate focus right now is on phase 3. They're targeting a final investment decision, the FID, that crucial commitment point by the end of 2025.
And they're moving forward on that already, signing documents.
Yeah, they signed a pre-final investment decision document recently. That followed an agreement with the Italian energy giant Eni, and they expect another important partner to join that joint venture soon.
And phase 3 itself, what does that involve?
It's planned for a location down in Argentina's Rio Negro province, and the goal is massive, producing about 12 million tons per year of LNG using 2 large liquefaction vessels.
Wow.
The aim is to have this operational by the end of the decade, though, schedules can always shift. And this phase also requires building significant new gas pipelines and offshore infrastructure.
But this isn't the only piece of their LNG plan, is it? There's also a phase one that's actually closer to becoming reality.
That's right. Phase 1 is the Southern Energy LNG exporting project. YPF has a 25% stake in that one. This project's expected to start service earlier, maybe 2027. It uses 2 vessels, total capacity 6 million tons per year.
Okay.
FID has already been reached for the first vessel, and a decision on the second one is due pretty soon, by end July. And YPF will supply a good chunk of the gas for this project under a tolling agreement.
And they even have a phase two planned as well.
They do. Phase 2 is envisioned with a capacity of 10 million tons per year, and that involves a partnership with Shell. They could potentially reach an FID for that phase by the end of 2026.
So this is a really significant multi-year effort, financing these later, larger phases, phase 2 and 3, that must require substantial project finance.
Oh, definitely. And the sources noted that having high-quality partners and proposed buyers for the LNG, like Eni, is expected to really help YPF access the necessary financing for these huge undertakings.
And the target markets for all this Argentinian LNG are primarily Europe and Asia.
That's the plan, yeah.
The overall perspective on these projects, described in the sources, is interesting. It's almost like a mortgage, right? You build the infrastructure, financed by the expectation that future gas exports will repay that investment over time.
Exactly. The profitability really hinges heavily on securing that infrastructure financing and, of course, managing the cost of extracting the gas from Vaca Muerta itself.
It really shows how companies are making these huge, long-term bets on future demand and supply, even while the short-term markets are being, well, buffeted by all these unpredictable forces we've been talking about.
And that brings us right back to where we started, doesn't it? We've taken this deep dive through technical trading signals for crude and natural gas.
Navigated the chaos of unpredictable policy, trade tensions.
Witnessed the direct disruptive impact of natural disasters like wildfires on physical supply.
And then looked at specific long-term industry investments happening despite all of that noise.
Understanding this incredible mix of factors, it's just essential to making sense of the energy world today. You can really see how tightly connected everything is.
Yeah, and how many different types of forces are shaping prices and decisions, from a pattern on a chart to a tariff announcement in a capital city to a fire burning out on the landscape.
And this complex, often unpredictable interplay, it leads us right back to that thought we started with. Given the increasing volatility driven by things like these sudden policy shifts, and what could be a growing structural impact from environmental events like wildfires, how much is the future of energy markets now being dictated by factors outside of that traditional analysis of supply and demand fundamentals?
Right. What does it mean for our ability to predict where things are truly headed when these unpredictable external shocks seem to be playing an ever larger role? Definitely something to think about as you continue to navigate this dynamic space.